Thank you very much. I feel like being completely out of agenda because all these people sitting here, you love ventures, you love fintechs, you do fintech, you build companies, you make these companies succeed. And I'm on the other side of the river. I'm a professional wealth manager. I've worked for about 30 years in business of picking investments for people who do not care whether it's venture or whether it's a conventional investment, liquid, illiquid. It should bring as much return to the unit of risk as possible. It should be as liquid as possible, as transparent as possible, as sustainable as possible. And obviously, we look into the ventures perspective. We tried many times to enter the area. We've consulted the clients. We've gathered the experiences of the clients. I assume in the years to come, the artificial intelligence will also gather the experience of clients and deliver it back to the managers of the companies. And I'm actually afraid of working as a little bit of a cold shower in a sunny day we have now in Limassol. To make the story short, I don't have too much time to teach the investments here. How do we wealth managers look at the venture capital industry and the fintech industry as well? We evaluate the investments based on certain parameters. Liquid conventional investors are liquid by default. The venture investments are illiquid, and the liquidity is not predictable. We know that the average lifespan of a VC fund and venture fund is about 10 years in practice, not on papers. There are capital calls. Some of them take less time, some of them take more time. Some ventures call the investors' money in the 6th and the 7th year of the existence. Some are shorter in the calling period, but liquidity is still bad. The market risks for liquid investments are much less than those for the illiquid investments. We now see how the valuations of the venture companies go down, while the valuations of the big companies or the liquid shares are much less volatile. There are plenty of other risks in the venture capital area, those that are not existent in the area of the liquid investments. And last but not the least, when we talk about the liquid investments, it's very easy to check the expertise of the providers, of the managers. We see the track records, we see the day-to-day activities of them, we can evaluate the strategies against the markets, do the benchmarking. When we talk about the venture capital business, venture capital is very hard to evaluate. The typical lifespan of an investor is maybe 30 years, maybe 20 years. We leave short. And if a venture fund succeeds in 10 years, you have just 2 or 3 attempts in your life. It's very hard to understand whether you do good or bad, or it's just the coincidence and the good timing. Then we probably needed a return, a superior return to justify for the venture investments. Then when we talk about the returns, the situation is not that easy as well. So this is the evidence from the British Business Bank. They collect the information about the venture capital as much as it's possible. And as you may see from that, both the DPIs and TVPIs here, the TVPIs are always higher, of course, are in a very comparable to the liquid investments range. So that's the TVPI statistics for the 21st century. You may see that only 11% of the funds, of the VC funds, deliver TVPIs of over 3. So pretty much if we talk about the 10-year span, the TVPI equal to 3 is something comparable to best liquid investments in the market. The median is very low. Almost half of the funds deliver the TVPIs below 2. And almost 1/3 of them delivers the TVPIs below 1, which means that they do not return the investors' monies back. When we talk about the DPIs, the distributions per investment, the situation is even worse. The DPI over 3 is a feature of about 6% of the funds, and the DPI less than 1 is a trait of 55% of the funds so far in the 21st century. It's very hard to say about the timing, because here we take the vintage of 2002, 2013, with other funds, they didn't have to distribute all the funds to the investors yet. But still, even in that good timing, the DPI over 3 is rare, and DPI over 2 is rare as well. And deep tech is not the best provider of the distributions. The deep tech venture funds, on average, deliver a DPI of 1.01 of that vintage, which is they merely give back money to investors. When we talk about the anatomy of the fund, all this data is taken from the wallet sources. They get the statistical information. And of course, this data is reflecting the average fund. And of course, there are better funds. And I have to say that about 1% of venture capital funds do really good. They deliver IRRs in excess of 25%. Some of them deliver IRRs in excess of 40%. And that's not a small number. There are thousands of funds in the market. The problem is that when you choose a venture fund, it is very hard to choose the right one. There are no criteria. There is almost no history for the choice. But again, while I'm talking about that, this is the anatomy of a good above median fund. And that good about median fund delivers about 6.56% compounded IRR to investors, which is okay, which is approximately a fixed income return over a long period of time. Unfortunately, without the liquidity of the fixed income and with higher risks. The remarkable thing about that is that the manager's share of the monies here is quite significant. The managers get about almost 40% of the invested amounts during the lifespan of that fund because of the construction of the management fees and the performance fees. A good successful, say, a border of the first quintile venture capital fund delivers on average historically about 14.5% to investors. That's better than the S&P, for example. A slightly better S&P has delivered about 12% per year. The managers consume about 92% of the initial investment as their fees. So the venture capital industry is very good for the managers. Being a venture capital manager is very good for your career and for your pockets. The attractiveness of the industry for the investors is not that clear. If we compare it to the liquid investments, for example, the S&P 500, the most reasonable and the most popular benchmark for the equity investments, 20% of the time, so that's the histogram of the returns for the 21st century. And indeed, there are losses, there are periods of losses, there are periods of stagnation, but about 20% of the investors, of the 3-year term investors in the S&P 500 get returns better than a successful venture capital fund. And about 58% of the time, these investors did better than an average good, better than the median venture capital fund. And of course, the investments in S&P 500 are more liquid, they are more stable, they are more predictable, to the extent they are predictable, of course. Talking about the best shares in the market, we can talk about the best venture capital funds. We can strive to invest in best venture capital funds. It's hard, most of them are closed, but still. But then we have to compare them to best shares in the market. So these are the results of the best shares of the market. For the last 10 years, not exactly the last 10 years, it's 2011, 2021. On top, you see the IRRs, and in the bars, you see the DPIs. effectively. And the DPIs are in the range of 160 for Tesla and 6 for NASDAQ on a whole, but the DPI of 6 is still a very good DPI comparing to the average venture capital fund. The hedge funds are doing also not bad. Both the fixed income and the macro and the equity hedge funds over that time deliver better than the median venture capital fund. And another important thing about that is that the macro is the worst strategy in that year for the hedge funds, which means that the venture capital funds do not have a good support of macro prediction. It's very hard for the venture capitalists to understand whether it's good circumstances for investing or bad circumstances for investing. And if you recall one of the first slides with the DPIs versus TVPIs, the spike in TVPIs in, for example, 2008, when everybody believed that the valuations were very low, that's why the spike in the TVPIs was not corresponding to the spike of DPIs. So the valuations were low, but then the quality of the investment, the companies invested, was also lower, and it didn't result in excessive returns. So, talking about the performance, historically the liquid markets provided for mid to high single-digit performance, and equities generated low double-digit performances in good times and low single-digit performance in bad times. And as the statistics shows, the venture capital funds on average deliver the mid-single to low double-digit performance as well. With that regard, there is no dramatic difference between the venture capital and liquid investments. In 2023, I've heard from many sources that 2023 is a very bad year for venture investments. Valuations went down. It's a problematic year for the vintages of previous years. The liquid investments, meanwhile, are not that bad. Again, you can see from the NASDAQ, which is 46% up year to date, to Russell 2000, which is a rather conservative equity story, which is 3% up. That's much better than the venture capital. And going forward, there are no good news. The things in the economy, in the global economy, are changing to the worse. All the drivers that were existent before 2022 are now gradually going out, and in the future they will not be present in the market. Starting with the monetary-based growth that now is monetary-based contraction, and lower global risks now are increasingly becoming higher global risks. Low refinancing rates are gone. We would not see low refinancing rates anymore. With that regard, I would not be able to say that the venture capital industry in the close years can expect a bright future and the growth of the valuations, the growth of the volumes. To wrap up in the last minute of my speech, the outlook for the venture investments for us, for wealth management, again, I apologize for bringing such news to such an audience, is quite controversial. We cannot say that the venture capital historically generated better returns than the conventional managers. We do not know about the future and have doubts about the future. We know for sure that picking a venture capital manager, a good manager, is extremely hard. The criteria for that is not yet developed. Maybe the artificial intelligence will do it in the future. We don't have them now. And the proportion, the share of successful managers is very low. We know that the high-tech or fintech, it's by error, it says fintech now. I didn't mean that. It's fintech, of course. Is not the best part of the venture capital industry. The biotech is, for example, much better on average. We see from the graphs that the venture capital aspirations are always high and higher than reality. TVPIs are always higher to start with than the DPIs at the end. The macro situation is the key to understanding of the success of the venture capital industry. When the macro is better, there are more money in the market, there are more investments, the valuations are higher, and you can make money. the macro would not be that good anymore. So with that regard, the current situation is looking that good, and I only hope that other speakers would bring you much more optimism than I did. Thank you very much.